Hello everyone, welcome to EduTap and welcome to today's session. So today we are going to discuss two very important news articles of finance. The first news article is regarding the Monetary Policy Committee meeting that has concluded on 8th June 2023. So this is the recent Monetary Policy Committee meeting that has happened, and this is the latest one before the examination. So this is very important from the examination perspective, from the RBI Grade B point of view. So we are going to understand that what the Monetary Policy Committee statement is saying and what decisions has been taken. So everything we are going to discuss in today's session. The second news article is again very important. It is regarding the financial inclusion dashboard that has been launched by the RBI's governor. Okay, so we will understand that what is this dashboard, how it is going to help RBI, and we are going to understand both the news articles. Okay, so let's start with them. But before that, do subscribe to our YouTube channel and join our Telegram channel for the PDF of this session. Okay, so you will get the PDF of this session in the Telegram channel of EduTap. The link for the Telegram channel is provided in the description box. So do join the Telegram channel and do download the PDF. So now coming to the Monetary Policy Committee meeting that has concluded in June 2023. So on the basis of the assessment has been done by the Monetary Policy Committee, and on the basis of the assessment of the current and the evolving macroeconomic situation of the country. So the Monetary Policy Committee has decided to keep the policy repo rate, that is the repo rate. So it has been decided by the MPC to keep the repo rate unchanged at 6.50%, and if you remember, the same decision was taken in the April 2023 also. Okay, so just let's understand the background that since May 2022 RBI was continuously increasing the repo rate. So in May 2022 the RBI increased the repo rate from 4% to 4.5%. Okay, and from May 2022 till, and this was the off-cycle meeting, until February 2023. So there was the continuous increase in the repo rate, okay, from the 4% to 6.50%. So in six meetings the RBI had increased the repo rate by 2.5%, that is by 250 basis point. So the RBI said in April 2023 that okay, we are stopping this increase in the repo rate and we are keeping the repo rate unchanged. So there was a pause on the repo rate increase that was done, and in June 2023 the pause is continued. Okay, so still the repo rate is kept unchanged. Okay, and this is the under the liquidity adjustment facility. So I hope you remember that what is the liquidity adjustment facility. So the liquidity adjustment facility, so in this there are the tools through which the RBI controls the liquidity in the economy. So there is the standing deposit facility, that is the floor or the lower limit of the liquidity adjustment facility that the RBI uses. Then there is the repo rate. Then there is the marginal standing facility. So the marginal standing facility is greater than the repo rate by 0.25%, and the SDF is lower than the repo rate by 0.25%. So in the LAF there is the symmetry that is present. Okay, there is the difference between the SDF and the repo rate by 0.25%, and similarly the difference between repo rate and MSF is 0.25%, and SDF is the floor and ceiling is the ceiling of the liquidity adjustment facility is marginal standing facility. So this is the liquidity adjustment facility. Through these tools, through the SDF, repo rate and the MSF, the RBI tries to control the liquidity in the economy. Okay, if the RBI is increasing the SDF rate, that means the RBI is increasing the deposit rate, that is the rate at which the banks deposit the money with the RBI. So you can understand that if the deposit rate is high, you will want to deposit in the banks. Similarly, if the deposit rate is high, the banks will want to deposit in the RBI, their money in the RBI. So you can understand that through this, the liquidity is adjusted and the RBI is trying to take the liquidity from the economy so that the inflation can be controlled. Okay, so this is how the different tools are used. If the RBI is increasing the repo rate, again, if the RBI was increasing the repo rate, what was happening? That the lending rate for the banks, so this is the rate, repo rate is the rate at which the RBI lends to the bank. Okay, so this rate was increased. So if the RBI is increasing the rate at which the RBI is lending to the banks, so similarly banks will also raise the interest on which the banks lend to the people. So through this also the liquidity was controlled in the economy, and when the interest rate is high, you will not want to do much demand. You will not want to buy a new house, you will not want to buy a new car, because the interest rate is very high of the car loan, of the home loan. So through this also the liquidity was controlled by the RBI. Okay, the banks will not want to take more lending from the RBI because the interest rate is high, the repo rate is high. So this is how the RBI controls the liquidity through these measures. Okay, so in this meeting it has been decided that the repo rate will be kept unchanged at 6.50 percentage. Now I have told you that the SDF is less than the repo rate by 0.25 percentage. So if the repo rate is 6.50 percentage, the SDF is 6.25 percentage, and MSF, that is the Martian Standing Facility, that is the ceiling, that is greater than the repo rate by 0.25 percentage. So MSF will be 6.75 percentage, and the MSF and the bank rate are equal. So the MSF is 6.75 percentage, so bank rate is also 6.75 percentage. Okay, so MPC has decided to remain focused. Now the RBI has decided to keep the repo rate unchanged, and that's why the other rates are also unchanged. So RBI is not increasing the repo rate to control the demand. Okay, so RBI is not doing so. So the MPC, but the RBI has said that the Monetary Policy Committee has said that the MPC has decided to remain focused on the withdrawal of the accommodation to ensure, that is the repo rate that was decreased before during the COVID time. So we are trying to withdraw that accommodation that we have done prior to ensure that the inflation progressively aligns with the target. That is, the target is 4% plus minus 2%. So the target is 4%. So the RBI wants the inflation to be around 4%. Okay, so for that the RBI has decided to remain focused on the withdrawal of accommodation, the kind of accommodation that was given during the COVID-19, that the repo rate was kept at 4%. The repo rate was decreased first, and then it was kept for 1 year, it was kept at 4%. So that kind of accommodation is being withdrawn now, and you can see that the repo rate was increased from May 2022 till Feb 2023, and now the repo rate is being kept unchanged at a high percentage. So that is the withdrawal of accommodation to ensure that the inflation progressively aligns with the target while supporting growth also. Okay, now I hope you remember the target for the inflation. So the target for the CPI inflation is 4% plus minus 2%. That is, the lower limit is 2%, that the inflation should not go below 2% and the inflation should not go above 6%. So this is the target of the inflation. Okay, now coming to, I hope you have understood the percentages. The policy repo rate is 6.50%, so this SDF is 6.25%, and the MSF is 6.75%. The bank rate is equal to MSF, so it is also 6.75%. The fixed reverse repo rate has been kept 3.35% since since April 2022. Okay, in April 2022, the SDF was introduced. In April 2022 MPC meeting, the standing deposit facility, this was introduced, and this was 3.75% when it was introduced. Okay, and since then the fixed reverse repo rate has lost its value, we can say. Okay, so it is not changed, and there is no change that is happening in the fixed reverse repo rate. So now I hope you understand that why the RBI has kept the repo rate unchanged. So the reason I have told you, when there was the meeting, April 2023 meeting that was done of the MPC. So in that the MPC has told that okay, we are keeping the repo rate unchanged because we want to see, we have already increased the repo rate from May 2022. That was the off-cycle meeting of the MPC. Since then the repo rate was increased till February 2023 in all the Monetary Policy Committee meetings. That is 6 times the repo rate was increased, and the repo rate was increased from 4% to 6.50% till February 2023. So you can understand that the cumulative increase was of 2.5%, that is 250 basis point. Cumulatively the repo rate was increased. So this is repo rate. When the repo rate is increased, the banks are taking the money, or the banks are borrowing the money at a higher rate. So the banks will also lend the money. At the higher interest rate. So due to this, when the interest rate is high, you will not want to take the home loan, you will not want to take the car loan and the other kind of loans. Okay. Due to this, the demand decreases. When the demand is decreasing, the supply will decrease, the growth will decrease. So when the repo rate was increased from 4% to 6.50%, you can understand that the interest rate is also increasing in the economy, and the demand is being curtailed to a level. So it is not like that, okay, today RBI will say that increase the repo rate and tomorrow the interest rate will start increasing and the other day the demand will decrease to a higher level. No, it works very slowly. And so the MPC said that it is still, the cumulative increase of the repo rate is still working through the system, and we are going to see the effects of this increase in the repo rate in 6 meetings that was done. So the MPC has decided to keep the repo rate unchanged in April 2023 and in June 2023, so that the effect, the complete working of the increase in the repo rate that was done before can be seen, and we can understand that, okay, how the repo rate increase is working in the economy. Okay, so as well as what has happened, that if you see in April 2023, if we talk about the inflation was around 4.70%. So the inflation is not at 4%, but it is around 4.4%. So you can understand that, okay, inflation is also kind of decreasing in the economy, and that's why the RBI has decided to keep the repo rate unchanged for now, to see the effect of the increase in the repo rate that has happened before, and to see that, okay, the inflation is decreasing. So due to this, there was no further increase in the repo rate that was done in this meeting. So you can see that it was necessary to evaluate the cumulative impact of the rate hikes that has happened before, and due to this, the RBI is trying to see the complete effect of the cumulative hike in the repo rate, as well as the inflation is also decreasing. In March 2023, it was around 5.70%, and in April 2023 the inflation has come down to 4.70%. So that's why in June 2023 the RBI has decided that for now we are not increasing the repo rate. The MPC will continue to keep a strong vigil on the evolving inflation, that if it increases beyond 6% again, so there is the vigil, there is the MPC that is continuously looking after the inflation and to control the inflation. Okay, so now coming to the domestic economy, according to the provisional estimates, so we have discussed that, okay, the economy is the growth of the economy was expected at around 7% for 2022-23. So this was the data that was released by the National Statistical Office, that the growth of the economy was around 7% in 2022-23. This was as per the February report that was released by the NSO, a February 2023 report, in which the second advanced estimates were released. Now in May 2023, the NSO has released the provisional estimates, according to which the NSO is saying that actually the growth that has happened in 2022-23 is 7.2%, that is higher than the prior estimate that the NSO had done. So the GDP, the real GDP growth accelerated from 4.5% in the quarter 3. So quarter data you do not have to remember, just remember that the real GDP growth for 2022-23 was placed at 7.2% as per the provisional estimates, that was higher than the second advanced estimate of 7%. Okay, and this was because of the support by the fixed investment that was happening in the economy, as well as higher net exports that happened in the quarter 4. Okay, so next is domestic economic activity remains resilient in the quarter 1 of the new year, that is the financial year 24 has started, that is 2023-24 has started, and in the quarter 1, that is April 2023 to June 2023, we can say April, May, June. So in this it has been reflected. So June has just started, so we have taken only the data for the prior 2 months as per what the MPC is discussing this. So the purchasing managers indices, that is purchasing manager indices, is an indicator of the business activity that is happening in the manufacturing and the service sector. So for the manufacturing sector and the service sector, the index is released that, okay, what is the business activity that is happening, and the business activity is growing, the purchase and the sale is growing, as well as then a cumulative or a composite index is also released for the manufacturing and service. So it is calculated separately for the manufacturing and services sectors, and then a composite index is also constructed for them together. So the purchasing manager indices give us the idea that okay, how the manufacturing sector and how the service sector are working. So as per the purchasing PMI for the manufacturing and services, it has indicated that there is a continuous expansion that we have seen, with the manufacturing PMI at a 31-month high in May, and the services PMI was a 13-year high in April May. So you can understand that okay, we have the quarter 1 data of the financial year 24, that is for April and May we have the data, and we can see that okay, we have grown by a lot in the manufacturing and services sector. On the demand side also we are doing good. The urban spending has remained robust, and the rural demand is also improving, though it is uneven. Okay, sometimes it is improving. In some months, the improvement is better. In some months, it is not that much. Investment activity is picking up, as reflected in the healthy expansion in the steel consumption and the cement output in April. The merchandise exports and the non-oil, non-gold imports remained in contraction mode. So the merchandise exports means the goods that are being imported that have gone down, the goods that have been exported, because the global demand is less, so the goods that have been exported are less due to the global demand that is quite low. And the non-oil, non-gold imports, they have also been contracting in the April, while the services exports sustained a robust expansion. Okay, now coming to the inflation, the CPI inflation, the consumer price index inflation was 4.7% in April 2023. So this is a good news, because from February 2023, in February 2023 the inflation was 6.4%. That has gone down in March 2023 to 5.7% or 5.8%, and in April 2023 the inflation has further gone down to 4.7%. So that is a good news for our country. This was due to the favorable base effect. In April 2022, if you remember, the inflation was around 7.8%. So inflation was very high in April 2022. So if we compare against that, the inflation that is happening right now must be low. Okay, or we can say the base effect, the base was quite high, and that's why when we are comparing the prices against the year on year, if we are comparing the prices or year on year, so we can see that okay, this much inflation is not present right now. So large favorable base effect, because in April 2022 the inflation was very high, the price level was very high. So against that we are comparing the prices of this April 2023. Okay, with softening observed across all the three major groups in the CPI inflation, that is the food we can say, fuel we can say, and clothes we can say. Food group inflation has eased, as I have told you, with moderation in cereals, eggs, milk, fruits, meat and fish, spices and prepared meals inflation, and deepening of deflation. So deflation means that prices are decreasing for the edible oil. So this is a good news, that the inflation for the food group, so the inflation for the food group has eased, has come down to a little. Let's say the food group inflation was 8%. Now it has come down to 6%. So the disinflation has happened in the food group. As well as if we see for the edible oil, the prices has actually decreased. The deflation has happened. In the fuel group, inflation in LPG is present. So there is the inflation that is present in the LPG, but firewood, chips, prices have fell, and kerosene prices slipped into deflation. So actually kerosene prices decreasing. Okay, so the inflation in LPG and firewood is there, and the chips prices has fell. The core inflation, that is the inflation without excluding the food and fuel, so this has dipped. So the core inflation has dipped. So this is a good news, that if we see the manufacturing goods and such kind of goods, so the core inflation has gone down, driven by the clothing, footwear, household goods and services, health, transport, communication and such kind of subgroups. Okay, going forward, the headline inflation trajectory depends on the food price dynamics. Okay, so mainly if we see that in 2022 also the inflation was very high, and this was mainly due to the food inflation and the fuel inflation. So now going ahead also, going forward also, the major inflation will depend on the food price dynamics. Okay, that the inflation is very high or not, it will depend on the food price dynamics. Crude oil prices have eased, but the outlook remains uncertain. Wheat prices, it is going, like the wheat prices have seen correction. It is going down now. And the milk prices, on the other hand, it is still under the pressure. So the CPI inflation for the 2023-24 is projected at 5.1 percentage. In the April 2023 MPC meeting, if you remember that the CPI inflation was projected at 5.2 percentage for the 2023-24, but it is still going down, like the projection has still went down to 5.1 percentage for the 2023-24, and the highest percentage, the lowest inflation is expected to be in the Q1. Okay. Now coming to the average daily absorption under the liquidity adjustment facility, I have told you that under the liquidity adjustment facility, the MPC tries to, or the RBI tries to adjust the liquidity in the economy, adjust the money supply in the economy. So the absorption was happening because there was too much money supply in the hands of the people, and that's why the absorption increased to 1.7 lakh crore in the April-May. That was higher than the 1.4 lakh crore that happened in February-March. The money supply M3 has expanded to 10.1 percentage actually year on year, and the non-food bank credit by 15.6 percentage. Okay, see, the money supply depends on the credit creation, or the money creation that is done by the banks also, because the banks are taking the deposits, they are giving the loans. Okay, through this the money is circulating in the economy in the higher numbers. So due to this also, when the credit is high, there is the huge credit creation that is happening, and due to that the money supply actually increases. Okay, it is a long process, you do not have to understand that, just understand that the money supply has expanded by the 10.1 percentage because of the credit growth, we can say. So the India's foreign exchange reserves were placed at US dollar 595.1 billion as on June 2023. So you can see that, okay, the reserves with the RBI is quite good right now. So now coming to the conclusion, the higher Rabi crops production in 2022-23, the expected normal monsoon for the coming year, the sustained buoyancy in the services should support the private consumption and the overall economic activity. So the government is giving the thrust to the capital expenditure, that is the expenditure on the asset creation, moderation in the commodity prices, and the robust credit growth are expected. So the credit growth is further expected to nurture the investment activity. So all these positive things are happening, and that's why the RBI has projected the real GDP growth for the 2023-24 to be 6.5 percentage. Okay. So this is the real GDP growth for the 2023-24, that is projected at 6.5 percentage for the year, the current year. But you can understand that it is below the 7.2 percentage that the NSO, National Statistical Office, has projected for the 2022-23 through the provisional estimates. The NSO has said that, okay, this is the growth for the 2022-23. Now this was higher. Why? Because of the this is higher, and the current projection for the current year is lower. So that is because the weak external demand we will see. Okay, that is the exports will be less because the global demand is less. Economic fragmentation is still happening. The protracted geopolitical tensions are there. The geopolitical tensions are going on, and that's why the RBI has said that in the current year we will be able to grow by 6.5 percentage. That is less than the growth that we have seen in the previous year as per the estimations. Okay, so now here you can see the whole chart. So the real GDP projection is 6.5 percentage by the MPC, and for the 2023-24 the projection for the inflation is 5.1 percentage. The GDP growth for the financial year 2022-23 is said by the NSO that it is 7.2 percentage against the 7 percentage that the NSO has said in the second advanced estimates. So as per the provisional estimates, the percentage has actually increased of the estimated growth. On inflation, the headline retail inflation fell to 4.7 percentage in April. That is lowest since November 2021. Okay, so 15-16 in the 15-16 months, so it is the lowest. Looking ahead, as the tables also show, the RBI is upbeat about both the growth and the inflation, that okay, the growth is going to be good, it is going to remain good, and the inflation will also be controlled. Okay, so higher Rabi crop production, winter crop that is harvested in March and April, as well as the forecast of the normal monsoon points to a recovery. So it points to the recovery in the consumption levels of the common Indian. So you can see, and the government is also thrusting and it is pushing the capital expenditure, so that is going to help the economy in a way. It is going to crowd in the private investment. It is going to crowd in the private investment, means that due to the government expenditure, the private investment can also increase, because there is the boost that is going to happen to the demand in the economy. Okay, when the government is expanding, so that means the demand is increasing. That is also going to benefit the private investment, the private companies. Okay. So this was all. The MPC took note of the moderation in the CPI headline. That is, in the March, it was 5.7%. That was lower than the February month. So it was around 6 point something percentage. So in April, it was 4.7%. So the CPI headline inflation is decreasing, and due to that, as well as the headline inflation that is projected to decline in 2023-24 from the 2022-23 level. In the 2022-23, the CPI inflation was around 6.7%. For the 23-24, we are expecting that the headline inflation will be around 5.1%. Okay. So you can read this, that the cumulative rate hike has happened of 250 basis points. So I have explained you everything. So this is the basic idea. Okay, now coming to the next news article, that is the RBI governor has launched Antardrishti, and this is the financial inclusion dashboard. First of all, what is the dashboard? Dashboard provides you the interface. It is the user interface that is providing you the data in the visual format, okay, in the graphs format, in the pie chart format. So if you have lots of data, the Excel sheet is filled with the data, and rather than that, you are getting this kind of data, that 73% financial inclusion and 27% financial exclusion. So rather than the Excel sheet, I would rather have this kind of pie chart and this kind of like graphs and all. So dashboard is a way of displaying the various types of visual data in one place, or data in a one place in the visual manner. Usually a dashboard is intended to convey the different but related information in a easy to digest form. A dashboard is a type of graphical user interface that provides the data, the key performance indicators. It's provided at a glance views. Okay, by a glance only you will be able to understand that, okay, what has happened in the economy. So this is relevant to a particular objective. So you can understand that through this financial inclusion dashboard, the graphical user interface will be provided to the RBI. So the RBI will be able to understand in a glance the situation of the economy in the financial inclusion category. Okay. So, as the name suggests, the dashboard will provide the required insight, the required knowledge to access, to evaluate, to monitor and track the progress of financial inclusion by capturing the relevant parameters as per the objective of financial inclusion. So, here the Antardrishti has been launched, that is the financial inclusion dashboard, and the facility will also enable to gauge the extent of financial exclusion that is present. Okay, so if we are getting to know the financial inclusion, that means we are getting to know the financial exclusion that is happening at the granular levels, at the local levels. So we can say that the RBI is collecting the state level data as well as the district level data, so that all the Excel sheets are being filled. So against that, we will be getting the data in the not we, but the RBI will be getting the data in the like the graphical format, the visual format. So it will be easier to digest, it will be easier to understand and to implement the programs as per the understood information, so that such areas can be addressed. So the RBI will be gauging the extent of financial exclusion that has happened at the local areas across the country, so that such areas can be addressed. The dashboard presently intended for the internal use of the RBI only, but if it is further provided to the multiple stakeholders like the bank or even the public or even the different like the NBFCs and such, so it is going to further help the financial inclusion. Okay, so the Reserve Bank of India has been promoting the financial inclusion through various policy initiatives. The Financial Inclusion Index was released in 2021, and this is based on 3 broad parameters. So Financial Inclusion Index is based on the excess, usage and the quality. That there should be the excess of the financial inclusion, the financial products and services, that you should have a bank nearby or you should have the ATM nearby. You should be able to get the financial products and services. Then if you have everything nearby but you are not going to such banks, or you are getting afraid to use the ATMs, so what's the point of providing you the excess? So the usage should be also there. The people should be so financial literate that they should be able to use the services that has been, or the financial products that will be provided, that has been provided. So the usage is given the highest weightage, that is the 45% in the financial inclusion index. And then there is the quality. Quality means that the financial products and the financial services that is provided, that should be of the quality product. Okay, like if you are going to a bank but they are not very welcoming, they are not very friendly, user friendly, so you will not want to go to the bank again, you will not want to go there. So the quality of the services should also be there. So the excess is given 35% weightage in the financial inclusion index, usage is given 45% weightage, and the quality is given 20% weightage. And the financial inclusion index surprisingly does not have any base year. So here is the complete information about the financial inclusion index, and the RBI is continuously working for the financial inclusion, and the RBI also collects the information. So you can understand that through the financial inclusion dashboard, it will be easier for the RBI to access and to gauge the kind of financial inclusion or the financial exclusion that is happening in different areas. Okay. So that's why the financial inclusion dashboard has been made by the RBI for the internal use. So this is the first question. I hope you will be easily able to answer this question. And this is the second question. So the first question is talking about the LAF facility where the repo rate has been kept unchanged at what percentage. So you have to tell that. Then the MPC meeting, you have to tell the inflation projection for 2023-24 is projected at what percentage. The third question is regarding the launch of financial inclusion dashboard. You have to tell the name of the dashboard. So we have brought for you the comprehensive guidebook for RBI, NABARD and SEBI. So through a single guidebook, you can get the complete syllabus, the sources from which you have to prepare for the RBI Grade B. So as well as we are providing you the PYQs in this document. So everything has been provided to you at one place. So you can understand that you can get the syllabus, you can get the sources, you can get the PYQs, the previous year questions also through these guidebooks. So to make it easier for you to prepare, to make it easier for you to understand all the information and to get your common queries answered, we have provided you this awesome guidebook. So to download this guidebook, the link is provided in the description box below. So thank you very much. I hope you have understood the session, and do raise your query at the hello@edutap.co.in if you have any query, or you can mail us here, or you can contact us through this number. You can comment down below if you have any query. Okay, thank you.